My name is Michael Gardner. I work with Gardner Capital. We raise equity for both affordable housing and solar power plants. We're also a developer of multifamily housing, both in the affordable and market rate space. We have quite a few specific examples that I will kind of bring up as far as issues that we've dealt with this issue, and we're going to try to mix it all together to try to identify some good issues that developers should be focused on going forward. So with that, we'll just go down the line here and allow each of these panelists to introduce themselves.
Good morning. My name is Cliff McDaniel, and I work with ARA Newmark, which is a real estate company that brokers apartments. I usually start telling people what I do, and they get confused as far as, are you credits or are you debt? And I said, no, I do what Jeff Kunis does. And then they go, oh, yes, got it. So unfortunately, my fallback is always to say, I do what Jeff Kunis does. So Jeff.
Well, thanks for that, Cliff. I appreciate it. Jeff Kunitz, I work with the Affordable Housing Group, CBRE. We were formerly with Marcus and Millichap, and some of you may remember us from there. Made the transition last December, and I usually tell people I do what Cliff does. Only a little more of it, but.
I think he uses the word lot, not little.
But no, thanks for coming. Look forward to this panel.
I'm just here to referee so they don't beat each other up. My name is Garrett Gibson. I work with Tidwell Group. I'm a real estate tax consultant in the firm, and mainly what I've been dealing with is lately is really a lot of exit analysis for my clients and all the things that sort of surround that exit, including some of the ROFR. And I don't do what these guys do. Maybe I wish I did. I don't know.
You've dabbled.
Don't bring that one up.
Okay.
Okay, well, guys, thank you very much for that introduction. So to start things off, Cliff's going to give us a couple different case studies that I think will be instructive in guiding this conversation, and we're going to go from there.
So ROFR, right of first refusal, is a term that a lot of people have become more familiar with. I think they checked the box 15 years ago and said, okay, whatever that means. And then 15 years rolls around, they start to look at what their options are, and suddenly they look at the box, they checked, and it says, right of first refusal. What does that mean? I think the first thing that most developers ask is, how do I get out of it? And it's like, well, okay, well, I think you checked the box, and I don't think there's not like an uncheck the box option. So your ROFR, or your right of first refusal that you signed up for, is now coming into vogue, and once you pass that 15-year mark, it's TDHC is going to be very interested in what you're doing. There's several different types of ROFRs actually, because it's almost like a wine. If you tell me the year you did your deal, I can tell you what kind of ROFR you had. It's like the 98 vintage early in the year. This is what it looks like. Later in 98 is a 2-year ROFR. So the ROFRs in the beginning ended up with right of first refusal was a ROFR in which if you wanted to sell your property, the agency would like for you to first spend 90 days offering it to the marketplace of nonprofits, and the price for that property was termed market rate. And so then there's a big discussion on what market rate means. So they gave you a couple options. One was you could go out and get an appraisal by MAI, and that would establish the market rate number that you would then offer it to the nonprofits. The other option was you could take it to the market and see what someone would pay for it. That was a for-profit, possibly, and that would establish the market rate. Well, here's the price. So if you did an appraisal and that established the market rate, the issue became if you did not sell it for that number, then you had to start over. So my property, the appraisal came in at $3 million. I offer it to the nonprofits at $3 million. 90 days goes by, nobody offers on it. And so then I have an offer, and the guy I'm at $3 million, he trades me down to $2.8 million because the roofs are bad or something. You go to TDHCA and you say, hey, guess what? Bad news went down a little bit. They said, yeah, really bad news, you're starting over. You're starting over now at 2.8 with that 90-day market rate ROFR. So now you're going to go forward with that. So I think most people would like to do ROFRs at their market rate. Go figure out what your number is, get it kind of locked in, And then you go to the 90-day ROFR and say, nonprofits, have at it, here's your number. So, because that way you kind of knew where you knew where you're going to be. And it was kind of a little bit backstop against the buyer, because the buyer said, here's the number I'm going to give you, and then suddenly that number changed, or he thinks he wants to have a lower price. You go, well, guess what? We're starting over. Your deal's out. I'm going to start. I forced by regulation, not my option. I'm starting over 90 days at that number that you want to start with, and that gives you a little backstop from the standpoint of never mind, I'll pay you the price. So that was pretty helpful. Yeah. The other ROFR that Jeff and I both worked on is the debt plus taxes ROFR. And that's an interesting ROFR because, and Gary's going to talk about this in a little bit, but debt plus taxes, those are the two words, but what does that mean? I mean, when you drill down, what is debt plus taxes? What does that actually mean when you say that's the purchase price? So TDHCA says you're welcome to sell your property, spend the next 90 days offering it to nonprofit at debt plus taxes, and that calculation has to be done. What's the debt? What is taxes? Those are both terms that have to be figured out because they mean different things to different people. So that's the debt plus taxes ROFR. I'm going to quickly just describe you 3 deals I'm currently working on. I think talking in terms of what about this deal? What about that deal? Let me just give you some real life examples. I've got buyers and sellers in here, so I'm going to be really careful.
Can you raise your hand if you're a buyer?
Yeah, if you're the buyer, raise your hand. If you're the seller, if you're the LP, they're all here. So Valley Ridge is 192 units in Lewisville, Texas. I'm selling that property. We originally sold it on behalf of Bill Bank to Crestmark. Crestmark purchased the property, and now they want to sell it. They had to go, every time you sell it, the ROFR doesn't go away. So we had to do a 90-day ROFR when we sold it to Crestmark, and now 3 or 4 years later, we're doing it again. Once again, 90-day ROFR. How do we establish it? This is a market rate. So we went to the market, extensively marketed the property, found a guy who wanted to buy it, and he, negotiations, he's at 14.5. Interesting nuance to it is that he's assuming a mortgage. So the ROFR price, when you see it on TDHCA, which is on there right now, it just gives you a price. His price is, I think, 14.5, and he's assuming it because there's $1.5 million in prepayment penalty. Well, you could, if you're a nonprofit, come in and say, great, I'll buy it for that price. And then there was this issue of, well, you have to assume the mortgage. Well, that's not actually what the documents say. I mean, it's like it doesn't say I have to assume mortgage. It just says you have to sell it to me at that price. So in this contract, we actually have a clause in which the buyer is at his option, can either pay cash of, we picked a number of $6 million, or assume it at 14.5, which cleared up that issue over whether a nonprofit could pay 14.5 or 16 million. TDHCA felt comfortable with saying that's apples to apples for a nonprofit. It's fair, we're not changing the terms. It's a market rate. The market is one number for assumption, one number for the cash price. That property is at max rents, max occupancy. It's 98% occupied. The buyer of that property is looking for yield and is satisfied with going forward. The AMI is going to move up. They kind of did the research. The second one is Park at Yellowstone, which is a debt plus taxes ROFR, and like I said, the buyers and sellers are here. So we got a really good price, but a fair price. So it was precisely marketed to the exact number. So this property was very interesting because it set up perfectly for a 4% resyndication. I see Jerry here. He was very instrumental in legislation that was passed in the last legislation that allowed now for a nonprofit to have a for-profit partner come in the essence an LP that would buy the tax credits in the syndication. So it allowed for a 4% resyndication to happen, whereas before, the only way a nonprofit could buy this property was they either had to have a lot of money or they had to have a partner that would come in and put in mezzanine debt because they could not enter the partnership as a partner. They could only be a lender. So how does that deal happen? It didn't happen. So the debt plus taxes ROFR, Jeff and I were talking about it earlier. There is not a situation in which someone said, hey, you know what? We got about $2 million in value in this deal. We got that debt plus taxes ROFR. Nothing we can do about that. here, we'll just give it to a nonprofit for $1. That has never happened. No one's doing that. You know, there's fiduciary responsibilities to your LPs and GPs. If there's value at that property, the GP and the LP want to find that. This syndication does that. This exact same property, Park Yellowstone, went through a ROFR earlier at debt plus taxes, and there was very little interest. There's one guy who had no chance of closing it. So this created a lot of value for the GP and the LP because of the resyndication and the ability to get the price into a number that works for them. Third, I have another property who went through the ROFR and cleared the ROFR. No nonprofits offered on it. And so now we are able to take it out to the market, and we are marketing it right now, and it will be a 4% resyndication deal. But it cleared the ROFR. So there are occasions where the ROFR, because this had market rate and LIHTC units, they were able to manipulate the valuation on an appraisal basis at a number in which no nonprofit was interested, and they then are now selling it to, well, we'll see who they sell it to. We're in the market with it right now, but with a lot of interest, but it'll be a for-profit. So
Was that a debt plus tax, or was it a market rate?
It was a debt plus taxes.
I know about it.
It was debt plus taxes, but they separated the market rate
Yep.
units apart
Okay.
from that.
So
It's
that
like
created-
debt plus taxes for this, but then you also had to add back in the market rates.
A lot of cash coming in.
So the one that made it through the ROFR, did it have a qualified contract ability for that? Did it cause the valuation of it to go higher?
There is a qualified contract ability on that, but the reality is that this location is an affordable location.
Oh, okay.
And so the highest and best sales possible is going through a 4% resyndication and keeping it keeping it affordable.
So they've been-
So on that kind of subject matter area, can you guys each kind of give an example? It doesn't have to need to be a true case study, which I really appreciate that. It was really very instructive. But if we're just talking about, you know, as standard as we can have as a 9% deal in Texas, kind of what the best procedure is, or what the recommended procedure would be from a developer's perspective, and then the biggest couple of issues that you guys see that are most material when we're talking about those valuations. So procedure and valuations.
Well, I think as everybody comes to that year 13, 14, 15, the discussions are occurring between the GP and the LP. I've been doing this for a long time, and 5 years ago, if there was a debt plus taxes ROFR on, the GP is trying to buy the LP out for $1. And I think that occurred in a lot of instances as investors, LPs morphed and tried to get the back end residual value on this. We kind of figured out there are ways to actually sell a property with the debt plus taxes ROFR, and that whole concept is a minimum price, right? So it just says minimum. It doesn't preclude anybody from paying more for that as long as they're qualified. But it's valuing the property, understanding what it is, understanding the ROFR, going through how that's going to impact it. The buying pool could be smaller for that, but we have instances where we've sold a couple properties in year 20 and 21 with a debt plus taxes ROFR on it, and we were able to put $14 million worth of proceeds in the general partner and limited partner's pocket. Because we were able to find a qualified purchaser who was willing to pay very close to market value. When we valued it, if it didn't have the ROFR, it was one number. We were only a couple percentages off of that of taking it to a qualified group specifically. And I think as Cliff and I are seeing, we're seeing more groups partnering up with nonprofits and CHODOs, and more of them are developing that actually have cash, or the mezzanine financing is working as well. So, one thing I want to just point out is that because it has the ROFR for debt plus taxes does not mean it does not have any value. And, thanks to the legislative changes last year, allowing now resyndications to occur on those has helped a lot. It's, Cliff just gave a couple examples of where those probably wouldn't have moved had that not been changed. And I know there's more changes coming up in the next session that may further that ability to do it. But there's value in it. But it's understanding the documents, understanding the ROFR. What does that mean? What are the buying pools? What are the buying groups out in this country that are looking for this stuff? how are they pricing? How is equity coming in it? And then what's the relationship, the GP and the LP, the capital account issues that we were talking about this morning, and just trying to run through all of that and going, here's what it really looks like if we take it to the marketplace. And the whole goal, I think, from Cliff, from my perspective, is developing a strategy, an exit strategy for the GP and LP. You don't want to be in,
And it always includes marketing the property.
always. Could be a shorter group, but there's a lot of options. So as the businesses morph, I think we look at it and go, there's opportunity, even when it may not look like there is for much cash, but as many limited partners have changed hands and been purchased by groups that want a return on their money, they are looking for that value. The days of giving up value, giving up capital account issues, giving up return of capital, are coming to a screeching halt with the amount of money that's come in and looking for the back end value of these.
Okay, so to Texas specifically, right, with regulatory changes of late, what have you seen as far as, you don't have to give it a really specific percentage, but something general as far as an uptick in re-syndications and also in valuations?
Well, I think the uptick is 0 to deals. I mean, there was really no re-syndications happening.
Right.
And so I think when I look at the values, I really feel like you're going to see the re-syndications are especially if you are an affordable property in an affordable, I mean, if it's like your rents are already maxed out, but they're close to market, and so there is no, there are some guys who can take it through the qualified contract and create a tremendous amount of value. There's a lot of these deals are not. But if you have a deal that's got good rents, got good occupancy, but it's not got a lot of upside, that is 4% re-syndication deal right there, central, because you can, your rents are, you're stuck with this lure anyway. So your value is not going to change very much. I mean, AMI is going to go up a little bit, maybe here and there, but really being able to put a lot of capital into it, which is what the syndication does, and re-up the facility and make sure it's going to go for the next 25 years. You need to put the money in there, and that's what works.
Okay, so from a qualified contract perspective, what are some of the markets in Texas specifically that probably makes more sense? I mean, we're talking about higher rents and higher incomes, so we're really talking about probably some suburban markets of the larger MSAs.
I think AMIs is what you look for. I mean, that's the AMIs, the ability to get the rents and they're at this level. That's where you want to. That's the. Sure. AMI growth, I think, and looking at the AMIs, and those numbers are important as far as which markets you're going to be.
Yeah, and that's, I mean, if you got a spread to rent, right? So if you're maxed out up in Dallas and you're, if it goes market rate, you got $250, $300, $400 rent spread. If there's the possibility to do that, that is very, guys will get extremely aggressive on that. We haven't seen a bunch of properties in Texas, compared to 20 other states that do this stuff on a regular basis. We haven't seen a lot of qualified contract, actually go through in our post sales, or we know they're there, we know it's it's capable, but a lot of those lures had right of first refusal checked and qualified contract checked, and it's sort of a gray area of groups coming outside of Texas in it, like how do you go through one and then the other? And there's been a couple done, but we haven't seen that many of them actually occur yet. As it morphs, we think it's going to be attractive to some groups, but they're in the the high cost areas. They're in the places where the market rents are significantly higher than the max rents.
And every deal gave up that right to qualify contract after 2002. So you're really, I mean, going forward, those are not even on the list.
Right. Okay. So you guys also mentioned a little bit about maximizing value from a GP and LP perspective, so that that inference is that relationship's pretty important because between the GP and LP. Can you guys touch on why that's important and why having a fairly good relationship with the LP at that point is important?
Well, I mean, we run into it all the time where a GP wants to do something and they have not asked their LP's position on it, and it's I get myself in a lot of trouble in my life by just asking forgiveness, not permission. But I would say, when a GP-LP relationship, when you're getting into years 12, 13, you're past the credit flow, it's good to sit down with your limited partners and discuss it. Like a lot of GPs, and we've had this discussion 100 times, is a lot of guys haven't read their partnership agreement since the day the deal's been closed. So they think they have some residual value. They think they have a 90-10 split. They don't necessarily know where the capital account sits. They don't know if it's a return of capital. They don't know if they have forced rights to sell. So you've got to get through all that as the GP and understand your partnership agreement. And then what is the motivation of the limited partner? Do they want to stay until you're 15? Do they want to get out in year 13? Those are all great discussions to have. But I think both Cliff and I have found that if the GP just does something on his own, even if it's a good idea, if he's not engaged as limited partner, it comes to a screeching halt at some point and it builds tension. So understanding exactly what's in the partnership agreement, what the philosophy is of the limited partner and their investors, and those investors are changing all the time and they have different motives. Some don't want to get out before year 15. Some want to get out in year 11. Some don't want to sell to their GPs at all. They want to market it completely. We like those, but you know, just building that relationship because they have the same goals, not necessarily the same goals, but they want to maximize proceeds. General partners want to maximize proceeds, and you're not going to get away with something anymore because of the sophistication of the investments that are now really looking at the back end cash.
And that's a very good point because I run into that all the time. I happen to be able to do work on both sides of the fence on that, depending on who hires me. But in most instances, if you're still an active developer, you do have a little bit of leverage there, as well, even from the opposite side. They know that if you have a lot of value there and you're trying to get the limited partner out, and they know that you're an active developer to do more deals, you know, that's always a situation too that comes in other than just the normal economics that comes out of the partnership waterfall. I recently just worked on one that was so specific to how that return should be back to the investor that as a GP I would get an advisor to run through some of this exit analysis because what was given to them after I computed based on the language in the partnership agreement just in various places, it got to the point where, you know, we shaved off several $100,000 just because of a computational thing and how the interpretation of this partnership agreement should really be interpreted. So it's a good point to how, you know, you're balancing back and forth of these things on a lot of this exit language.
So, sorry to interrupt you guys, but so sometimes this gets a little more amorphous. Can we get down and just give us some specific numbers that you've seen where you've seen, you know, a disparity in value that could be applied to a very similar deal based solely on how the partnership agreement was drafted, especially in this area, and or maybe what methodology you were using in valuations? Because in the end, it all kind of comes down to numbers for us, right? We're looking at it, we're dollars. And so we're trying to value the importance of this and, you know, really how much time we should focus on the front end when we're closing and how, you know, how predictive we can really be, you know, 15 years from now. But just give us some, you know, kind of hard numbers on what, you know, how important is this really?
In terms of the valuation, I mean, if you're a GP, I mean, we all know there's another panel later on. If you have a really large positive capital account, you know, these guys can come up with a $15 million valuation. Doesn't necessarily mean as a general partner you're going to get the value that you thought you were going to get. So there's always that aspect other than just coming up with the valuation of the property.
You know, I don't really have great, I guess, stats on how many we value in, you know, from a residual value, how much that creates an issue because it's not, you know, the GP might think something and the LP might think something, but I think what Cliff and I have learned over our long careers is that we can value the property in the market. We're going to tell you it's worth $15 million and it's going to sell for $15 million. But what we don't want to ever do is go to market without the GP and the LP going through that back end waterfall, because a lot of times, and I don't know if it's 15 or 20% of the time, there's a large discrepancy of what the final proceeds and what who it breaks down to. And that takes a lot of time, you know, and sometimes, you know, it takes 6 months to get, once we value it, to have the GP and the LP come to conclusion of, oh crap, this is really what it is, but it really is what it is. So do we want to just not sell it? Do we not want to do anything? Do we want to get in a fight? But the reality is once you know what it is, then you can actually have the discussions and go, okay, I thought I was going to get $5 million. Best case scenario, I'm going to get $3 million. Okay, I get it. now let's go. But it's having those discussions, because I think in our earlier days, we probably both have gone out to market on a property where at the end of the day, the waterfall splits they didn't work out, they weren't resolved, and we couldn't sell it. So we've stopped doing that quite a bit and making sure that when we're listing a property or we're going to go to market, we understand the relationship between the GP and the LP, and they've vetted that out completely, most of the time.
Yeah, and I've done my last deal where the GP comes and says, I want you to sell my GP. And I'd say, well, can we go talk to the LP? And they go, no, we're going to surprise them. And it's like, yeah. I'd prefer to talk to them right now. So, but yeah, as far as, I mean, what I've learned is this, is that, sometimes you become a counselor, it's like you almost, holding their hand as they realize that what they thought they were going to get wasn't there. And I said, the truism in life is you don't get what you deserve, you get what you negotiate. And that never comes more. It's like, I've done all the work. I've been here every day. And now suddenly they're going to get all the money. And I thought it was 90-10.
You never wanted any of the residual value anyway.
Where were you 10 years ago? So, but the reality is, like, you know what? You face, and I also call the limited partnership agreement is more like the prenuptial agreement, for the divorce. And it's like, this is what we agreed to. This is, you get the kids and I get the house, and I don't know who's going to get the golf cart. But I mean, that you go back, you look at it, and you go, this is it. And that, sometimes you can say, this is where I have some leverage, though. And the ROFR is a lot of, the developers want to use the ROFR as a lot of leverage and saying, well, it's debt plus taxes, so can't have any value here. And Jeff and I have kind of ruined that in some regards, because then they come to us and ask us, well, what do you think the value is? And I said, well, I can sell it for this. And so debt plus taxes is $7 million, but I can sell it for 12. And so that becomes part of the discussion between the LP and the GP, in which we're, like I said, we're just the counselors in there that look at it. But at the end, I think I've always found where the LPs and the GPs wind up doing something, in the Ferris deals where everybody thinks they got cheated. It's like, I gave too much. If everyone feels like they gave too much, that may be the fair split on it.
Yeah.
So would you say in general terms you see a lot of the times that GPs are somewhat surprised by what they end up getting versus what they thought they were going to get?
A lot of the times. I mean, to the point where there's certain strategies now that have come to light, recent changes in accounting methods for LIHTC investments for corporate investors. So there's certain things that they can do now that we're up front now, especially in newer deals that are structured now, because we have a lot of problems with positive capital counts. So the only thing that's going to make that go down is cash, which obviously you don't want to give cash to the limited partner. That's not necessarily the arrangement there. Or losses drive it down. And so if we're talking about trying to plan ahead of time, so when you get there, these 9% deals have really large positive capital accounts, might as well structure something up front that'll enable it to get as low as possible, because a positive capital account in that world, it means value. And when you're in year 15, that value is really $1 for that capital account. That's what you're negotiating once they've determined what that fair market value is that's flowing through that waterfall. So if you can do things up front, that also makes the investor sort of neutral from that perspective, like giving them losses earlier because they're going to get those tax write-offs. It's going to help their yield. That new accounting method now puts those losses sort of below the line, so it doesn't affect their earnings per share or whatever they call from a GAAP perspective. So if you're structuring a deal now, you don't want to get into year 15 and go through this process and realize that you're not, as a general partner, not getting what you at least thought you were going to get because of the positive capital accounts. There's things that you can employ early, whether it's cost segs or other types of things. There's bonus depreciation, anything to do it early on to drive that capital account down. So in year 15, when you get to this point, instead of a $3 million, it might be $500,000, which is a lot easier to negotiate on your value versus sitting there going, well, they gave us a price, we're going through this process of what we're selling it for, and I got to hand over $3 million before I even get my 90% piece of it, if it's a 90-10 split. So that's something that you can plan early on now. It doesn't really help you with deals that are already to that point. However, it might help you midstream. There are sort of tax tools that you can implement there to be able to do that now, depending on, again, if you've talked to your investor and they're willing to do that particular strategy because they might need yield in that fund, who knows? They might even be coming to you asking for mechanisms for accelerated losses. So yeah, I mean, I know that's sort of off topic of a ROFR, but certainly not off topic from what you're getting once you sell this property at this value that you're coming up with.
Right, and I think that speaks to, you know, a specific issue that would be relevant to someone that's, say, closing a deal right now. And so, you know, I think that when we're looking at these dollar volumes, you know, their magnitude is significant enough where you really want to have a significant focus on some of these issues today when you're closing a deal today. And so would you guys like to comment on anything specific as far as stuff to focus on? I mean, obviously a shameless plug would be to, you know, really engage with your third-party service providers on issues specific to this and be willing to spend some time at the negotiating table really talking about some of these issues, even though they're a long way off. The dollar values are real, right? I mean, if you look at it as a percentage of the total value being created in some of these deals that are awarded, it's rather significant. So do you guys want to talk about that a little bit?
Well, I think a lot of people are looking at, and I think if we were to all go back 15 years ago or 20 years ago when this was all coming about and you're checking the box in the ROFR, I think the mentality is I'm getting a developer fee out of this deal and maybe some little cash flow, but look, when we look, everybody's looking at this thing and it looks like there's, at the end of the day, in 15 years, it's not going to have much value. And then, lo and behold, surprise, surprise, interest rates go to 2 and AMIs are up and suddenly, wow, all of our models did not predict this. We didn't have any models that looked like this. And so there's value that was never, perceived that was going to be there. So suddenly the LPs are caught off guard going, well, we never thought about this. And the investors are going, yeah, well, money's money. So, hallelujah. So, we want what we can get. And so this ROFR at the time, people are saying, yeah, I'll check the box on that because, at the end, I just want out. Everybody had this whole mentality. And so now you're looking at it and you're going, okay, let's model it forward. If you're doing deals today, I can promise you, good counsel and everybody, they're looking at this issue right here because they want the LP to say, you're getting your return, and then we want to model the exit in such a way that we're not where we are today right now, where we have upside down capital accounts, and I thought I was getting this, and then I got that, and all this stuff. And so I think, if anything, what we're talking about happening right now is creating the documents that are being written right now by you guys. And I mean, you're probably seeing that from the standpoint of what is the GP, how does he view the end of 15 years? How do you view the end of 15 years? And what do you want it to look like, right?
Yeah, no, I mean, it's becoming a much more talked about and negotiated topic, for sure.
Yeah. And it may be in 15 years there's no value. It's like it reversed and suddenly it's like, spend a lot of time trying to figure out the value and there's none.
To kind of reiterate that point, it's, what's going on now and what GPs and LPs are negotiating is based off a lot of mistakes that were done in the past. There are a lot, as we see often, there's no exit, forced language, so there has to be some negotiation. Is there a return of capital? Yes, but there's no forced right. So the GP gets the cash, on a sale the LP gets it. So, I think that's where Cliff and I and other, third parties come into play is being in the middle of those negotiations, based on real estate value. So, it is partnering up with people who know what they're doing in this industry, making sure you have the right counsel, making sure you have the right valuation services, and getting to a value on the property and then kind of getting it back through there. But knowing what's in the documents, engaging in the dialogue, especially on a lot of the partnership agreements I think we see now, there's a lot of uncertainty in some of the partnership agreements. What does this really mean? Do I really have to return a capital? Is the capital account really ahead of my deferred developer fee? How does this? There's a lot of vagueness in some of those, and those have been, I think, straightened around for the most part going forward. But like Cliff and I are in the middle of a lot of those that, partnership agreements that just have issues, and all of them have to be addressed in a, common sense professional way that you come to a conclusion here, there's no way out, there's got to be some negotiation, there's got to be a little bit of give and take. But again, I think once we value the real estate, it's understanding that, this is really the value. How we get to the end line and how the proceeds get divvied up just needs to be addressed. Kind of simple.
Yeah.
We make it hard.
It's just math.
And until you compute it and you send it back through, and there's a recursive loop in there, and you're scratching your head, and there's 3 people submitting how the waterfall should be interpreted, and that's a problem. If I compute one number, somebody else computes a number, then they get another person to compute it, and we're all different. That's a pretty horrible partnership agreement, if you ask me. I just think that if you're drafting stuff now, go through the waterfall with the computation, and at least everybody agree. I mean, when I worked in private equity, when you're doing commercial real estate, sometimes the formula, they'll put it there with just makeshift numbers walking through it, so everybody agrees. That's how we're computing this hurdle rate right here. But you just don't see that in affordable housing, and they're the most complex waterfalls that you see sometimes.
So we've talked about different time periods from year 15 to we're closing deals today. Obviously, all of the developers and LPs are going to have their own accounting firms that are going to be working on some of these issues throughout the life of the project here. When is the best time, if there is a good time, but how early on should GPs really start to be focusing on some of these issues and valuations, and starting to talk to some parties about what they might do in this process when year 15 does come down?
I think it's your intent, right? I mean, there's value there for general partners in specific instances from a tax planning strategy right after year 11 when the credits are done. So there's things, you might want to get them out at that point, but that doesn't always mean that the investor either wants to or can. There might be investor pools in that syndicated fund that just don't allow it. So it's not like they're playing hardball. That's just what's in their documents at the upper tier. So they have to get some of those permissions. But other than that, I think the more you communicate with them with sort of your intent, not necessarily giving them your whole strategy, but just the communication, because even from the investor side, they have an upper tier that they have to sort of communicate with them what their intent is. And it's a long process. It doesn't just, you don't overnight just say, hey, I want you to get out tier 11. What do you think about that? That's probably the wrong way to do it. If that's kind of your strategy, maybe you start hinting that to the asset manager and try to get into the point where you're talking to somebody specific that really would enable that transaction to go through.
I would say if I was a developer or even an LP, I would look at my deal every single year after year 10 and say, what is the value and how does the waterfall work? If I were to sell today, what would it look like? Because you have no baseline to really judge what's happening. So it makes perfect sense to me if it's an asset that I own, I'd like to know what it's worth and what I have. Because a lot of people go, I'd like to sell my property. How much is it worth? What do I get? And it's like, what do you own? It's like, well, I own the property. Well, you don't really own the property. I mean, you have this piece and you have that piece, and if we ran it through the waterfall, this is what you would get. That's what you actually are selling. So, if you'd ask me for advice, I would say it makes perfect sense to me. I would look at every one of my deals, and I would look at the value of it and run it through the waterfall, and I would know what I'm getting every year. And if I'm seeing something happen on an asset, it's like suddenly it's like, wait a second, this isn't going my direction. That's the time to go back and try to figure out what you can do, as far as different pieces. And I know that.
Well, I mean, that's a good point. We do that for our clients.
And
there's so many different things you can do, whether even if it's modeling or refinance. But for our clients, what we'll do is we'll run models for them on a tax basis, so that we know every year as actuals come in where this thing would liquidate based on my conversations with these guys. Where's the value now? What's the cap rate I can use? So every year you can look at it and say, well, I mean, if we did this now, this is where we'd end up. Because I'll be honest, if you can somehow exit between year 11 and some duration of time, there might be a time frame between there that's the most beneficial time to exit, because at some point it could start tipping the other direction. But knowing what that is, especially if you have a really large portfolio that might have some of the same investors in it, you might be able to go in a year 11, 12, or 13 deal and pull those together. there's less transaction fees, and it might be a little easier for that transaction to happen, given the fact that, you know, there's some efficiencies there. So without looking at it on, you know, deal by deal, by the way, it's really hard to sort of know where you're at any given point in time.
We work with a lot of clients and limited partners, general partners. We start looking at their properties in year 8, end of year 8, 9. What we want to try to do is help, you know, prioritize, bucket them, look at the values, get the models in there so Cliff and I can update them as needed and go, you know, here's where it sits today, and if the market changes, here's where it's going to go. Do sensitivity analysis on interest rate risk. You know, if you're in year 11, you know, once you start looking at a property in year 9, you got a couple years. But trying to, you know exactly what it's worth today, know what it looks like on a trend it's going to be worth in year 11. Finding out if your limited partner is willing to sell in year 11. Do you prop it up for sale then? Do you want to own it then? Or if the limited partner says, sorry, this investor will never sell before year 15, okay, how do you maximize value to that point? You know, do you want to put more capital into it? How are you going to do it? But continually updating the values, knowing what you have, knowing the right time to sell. You know, we know markets around the country, and some might be horrible today, but once they start turning, or we see that they're starting to turn sideways, you know, we can go to the GPs and LPs and say, here we are today, this market's going sideways, is it time or is it not? And then you make those decisions based on some of those things. But the sooner you look at it and the sooner you understand it, the better. You know, waking up in year 14 and going, oh yeah, I want to sell it today, when you don't even know, you know, sort of the operations and you're not doing anything to maximize value, you know, probably isn't the right move, or you're leaving money on the table if you do that.
Okay, thanks. Do we have any questions from the audience? I didn't get anyone interrupting me this time, so.
Could you speak to the definition of a minimum purchase price? It was my understanding that PDHCA considered that just the debt that was secured by the mortgage and didn't include any deferred developer's fee or GP's capital contribution.
Yes,
So the question's about minimum purchase
the debt
price and
secured by the
TDHC.
property, basically, and then exit taxes. If you ran through a transaction, what would those exit taxes be in that transaction? And so, and then I guess you have a 5-year look back. You can't just go slam a bunch of debt on it right before you go through that computation. But I mean, based on what we're hearing up here with it almost seems like that whole ROFR process now is kind of sort of irrelevant in terms of that computation, because you're likely going to get a higher value, or at least in this market, I would think, unless the property is, you know, deemed worthless.
It really is irrelevant. I mean, it's like I said in the beginning, no one's ever done it. No one's ever sold their property for debt plus taxes unless it was worth less than debt plus taxes. I mean, if it's worth $2, they're going to get $2. And so I'm sure 15 years ago, when the drafters were drafting this, they thought, well, this will be awesome. The nonprofits will own it, and then they, you know, they're great people, and so and affordable housing go on forever, and they drafted it in that fashion. But the reality is that that's the minimum number, but it's worth more than that. So we know. I don't even go through the ROFR process. We just sell it. If it's a debt plus taxes to a nonprofit ROFR, we market it and just sell it to a nonprofit. And then you go to TDHCA and say, I'm selling it to a nonprofit. Okay, so you don't have to enter that ROFR process of putting it on their website and showing all the documents and, you know, the survey, all the stuff you have to do to actually do a ROFR.
But I think you're correct. It is really just the in-place debt. It doesn't include any developer fee. It doesn't include accounts payables. It doesn't include loans, right? So that loans from the partners in it. So it's really secured debt on the property. I'm not exactly sure on how all the soft debt gets rolled through some of these things. So that probably shouldn't have said I don't know how to do that. But
if it's secured by the property.
It's the lowest amount of debt secured by the property in the past 5 years.
right,
That's
okay.
correct. And keep in mind, that still doesn't mean anything to that's just what the price that you're selling it for. If in fact you do that, that has no bearing how whatever residual cash from that sale gets to the partners, because that's a whole separate thing. If they assume all this debt and there's an extra $2 million that came from the exit tax piece, that's still got to go through the waterfall in the partnership that just sold it through a liquidation. because you're sort of dissolving that. So it doesn't necessarily mean that exit taxes goes to the investor. So sometimes people, I got to give that to the investor. No, I mean, it could be a situation where whatever that cash that comes in that waterfall ends up going to the general partner. However that waterfall splits, just irrespective of the fact, that's just the price that's being computed that you're actually going to sell the property for.
Okay. Do we have any other questions from the audience? Okay. Any final comments from you gentlemen? Any other last issues you'd like to bring up?
There is no way to find the true value without marketing it, right, Jeff?
100% agree.
So yeah, get
Or
advice.
finding the tax liquidation value without
So,
running through a company.
Get advice early and often is, I think, the main takeaway here. But if you guys would all join me in thanking our panel for a great panel this morning.